Samudha from School of Management, Shastra University. I welcome to the session ratio analysis. We shall see some problems on ratio analysis. First problem, assuming that the debt equity ratio is 2:1, state giving reasons whether this ratio will increase or decrease or will have no change in each one of the following cases. First case is purchase of fixed asset on long-term deferred payment basis. Deferred payment will mean the payment in the future date. So, we are purchasing a fixed asset and the payment is made in a future date. Purchase of fixed asset on a credit of 2 months. So, we have a credit purchase and that payment will be made after 2 months. Sale of fixed asset, book value of rupees 40,000 at a loss of 5,000. We are selling a fixed asset, value of rupees 40,000 at a loss of 5,000. So, the sale value is 35,000. So, the book value is 40,000, we result at a loss of 5,000. Next transaction is sale of fixed asset, book value is 40,000 and it is sold for 50,000. Now, the book value is 40,000 and the sale value is 50,000. So, we result in a profit of 10,000 rupees. Next transaction is issue of new shares for cash. So, it is a fresh issue of shares. It may be either equity or preference shares and it is on a receipt basis, that is what for cash. Next is issue of bonus shares. Bonus shares will be issued by way of capitalizing the profits. That is, bonus shares will be given to the equity shareholders by capitalizing the reserves and surpluses. Redemption of debentures for cash. Redemption here means repayment of debentures for cash. Next is conversion of debentures for cash. So, we are converting the debentures and we are paying it for cash. Then declaration of final dividend. Now, we shall see how all these transactions will have an impact on debt equity ratio. First transaction, purchase of fixed asset on long-term deferred payment basis. See to it, the effect will be the increase in the debt equity ratio. Now, we shall see what is the reason for the increase in debt equity ratio. Debt equity ratio studies about the relationship between the external equity and the internal equity. External equity, we mean the long-term loans and the borrowings, namely the debentures and the long-term borrowings from the financial institutions and other institutions. Internal equity, we mean the equity shares on your preference shares and your reserves and surpluses available for distribution to the equity shareholders. So, the relationship between debt and equity will be revealed in a debt equity ratio. Now, we have to see what is the reason for the increase in the debt equity ratio for this particular transaction. The transaction being purchase of fixed asset on a long-term deferred payment basis. When we purchase a fixed asset, we have the increase in the fixed asset and we are purchasing it on a deferred payment basis. So, the payment is made on a future date. Again, it will increase the liability also. See to it, the long-term debts are increased. So, long-term liability increases and your shareholders' funds remains unchanged. Whenever we mean shareholders' funds, we mean the preference shareholders' funds, equity shareholders' funds and the reserves and surplus. So, when we purchase a fixed asset and it is paid on a long term, the relationship will be between fixed assets and your long-term liability. The long-term liability being our external debt, we have an increase in your external debt, but the internal debt remains unchanged. So, when we have an increase in your external debt, the debt equity ratio will increase. The formula being external equity divided by internal equity, debt divided by equity. The next one is purchase of fixed asset on a credit for 2 months. So, it is a credit purchase of fixed asset. Again, the total long-term debts nor the total shareholders are affected. It will not be affected, both the accounts. That is, when it is purchased on a credit for 2 months, it is a short-term liability. When we have a short-term liability, we mean it as sundry creditors. So, that will be revealed only in current liability. It will not have an impact on your long-term liability or your shareholders' funds. So, neither the shareholders' funds nor the long-term liability gets affected. So, in this case, no effect will be made in debt equity ratio. Let us pass on to the third transaction, sale of fixed asset, the book value being 40,000 at a loss of 35,000. So it is sold for at a loss of 5,000. So it is sold for 35,000 rupees. Now we have to see whether this will have an impact over the debt equity ratio. The total shareholders funds are decreased by the amount of loss because we have a loss of 5,000. This loss will be adjusted only in the shareholders funds, namely the capital. So the shareholders funds will get decreased and the total long-term debts remaining unchanged because we don't borrow anything, we are selling it. So the cash will be coming. This cash is a current asset. So the impact on your current asset will not have any effect over your debt equity ratio. Now, the impact on your shareholders funds to the extent of the loss of 5,000 will have an impact over the debt equity ratio. So we have an increase. So the shareholders funds are decreased. So the denominator, namely the internal equity, decreases, the numerator being the same. So in this case, the debt equity ratio increases. Next transaction is sale of fixed assets, book value of rupees 40,000 and it is sold for 50,000 rupees. Now, it is sold for a profit of 10,000 rupees. This profit on the sale of fixed asset will increase the shareholders funds. So the total shareholders funds gets increased by the amount of profit. So this 10,000 will increase your shareholders funds. So the denominator gets increases. The numerator being the long-term debts remain unchanged. Being the numerator remaining unchanged and your denominator increases, we will have a decrease in your debt equity ratio. I remind again, debt equity ratio is debt divided by equity. That is your external liabilities divided by your internal equity, namely the shareholders funds. Next is issue of new shares for cash. Now, when we are going to issue the new shares for cash, the cash will increase, namely the current asset. Again, the current asset has no way related with your debt equity ratio. Now, shareholders funds are increased because the share capital is increased. So, whatever amount you are going to issue it in the form of shares will increase your shareholders funds. Now, the total long-term liability remains unchanged because the other aspect is the cash, which is a component of current asset. This current asset will not have any impact on your debt equity ratio. Being the shareholders increases, now we have the denominator as increasing, numerator being the same, the debt equity ratio is going to decrease. Next is issue of bonus shares. When you are going to issue bonus shares, the reserves and surpluses existing in the balance sheet will be capitalized, will be converted into capital. Normally, the reserves and surpluses are issued only to the equity shareholders because these reserves and surpluses are said to be the profits which is not distributed to the shareholders, namely the equity shareholders, and maintained as a corporate savings. At a future point of time, this resource will be converted into bonus shares given to the equity shareholders given at a ratio decided by the board of directors. Say for example, for every 5 shares held by the shareholders, they will be given 2 shares. Now this particular equity shareholder who is having 5 shares in their hands, they will have 7 shares now after the issue of bonus shares. So this wealth of the shareholder is increased. This is called as wealth maximization, which is said to be the main objective of any corporate. Now we have to see what is the impact on your debt equity ratio when the bonus shares are issued. When the bonus shares are issued, neither the long-term debts nor the shareholders funds are affected. I will say why the shareholders funds remains unaffected. Say for example, when your shareholders funds components are taken, we will have equity share capital, preference share capital and reserves and surplus. Now when the bonus shares are issued, the reserves and surpluses are converted into equity share capital. So we have a very small change within the shareholders funds. So the amount of the shareholders funds will not get changed. They will have a reorganization of their own funds. So it is not affected. Again, long-term debts is not affected because it's a non-cash transaction. We don't have any current asset affected and we don't have any liabilities that is taken from your outside parties. So this long-term debts will also remains unchanged. So there is a conversion of accumulated profit into share capital. So we don't have any change on the bonus shares. I repeat again, the components of shareholders' funds will get reorganized. The reserves and surpluses will get reduced and your equity share capital will increase. So at the outset, shareholders' funds remain unchanged and we don't have any change in the long-term liabilities also. So the debt-equity ratio will not get any change. Next is redemption of debentures for cash. Redeeming of debentures means repaying of the debentures. This long-term debts gets decreased because the debentures are repaid. When it is repaid for cash, the cash will also decrease and again that is a component of current asset which will not have any link with your debt equity ratio. Now the total shareholders funds remains unchanged. See to it, the long-term debts decreases, that is your numerator decreases, the denominator being the same. So we have a decrease in your debt equity ratio. Next is conversion of debentures for cash. Now again, long-term debts are decreased and shareholders funds are increased by the same amount because when we are going to convert the debentures, this conversion will be made to the equity share capital. That is, it is converted into cash, again that will be converted into equity share capital. So shareholders funds will get increased by the same amount and your long-term debts will also get decreased. So we have a decrease in the debt equity ratio. Next is declaration of final dividend. We are going to declare a dividend. So when the dividend or declared, the shareholders funds are decreased by the amount of profit appropriated because it will be, dividend will be declared only out of the profits that are available for the equity shareholders. So the shareholders funds gets decreases and long-term debts remains unchanged because any dividend declared on the annual general meeting is said to be a current liability and it will not have any impact on your long-term liabilities. So this long-term liabilities remain unchanged. So current liabilities only will get increased because any dividend declared in the annual general meeting should be paid within a month or 45 days, whatever the act specifies, and it is said to be a current liability. So it has an increase over your debt equity ratio. That is, your denominator gets decreases and your numerator remains unchanged. So we have an increase in your debt equity ratio. So this is the way in which the impact on your debt equity ratio will be studied. So whatever the transactions we have, everything should be reasoned out and we have to find out whether it will have an impact on your long-term liability or your shareholders funds. So only when we have a impact on your long-term liability and shareholders funds, we will have a change in the debt equity ratio. If you have any change in the current liabilities and current assets, it will not affect your debt equity ratio. This debt equity ratio always specifies about the long-term solvency of an organization. So it says about your capital structure, what is your ratio of debt and what is your ratio of equity. So any leverages that has been made in an organization, any inclusion of debt in your organization and or any increase in your capital of your organization will get an impact over the debt equity ratio. Next problem, calculate the stock turnover ratio from the following information. Opening inventory is 20,000, purchases is 1,60,000, closing inventory is 60,000, and we have to see whether the following transactions will have an impact over your stock turnover ratio. What is the formula for stock turnover ratio? That is cost of goods sold divided by average inventory. What is average inventory? That is opening stock plus closing stock divided by 2. What is your cost of goods sold? It can be net sales minus your gross profit. Otherwise, purchases plus your opening stock minus your closing stock. So either way you can calculate your cost of goods sold. So from the information given in the problem, we have to first calculate what is your average stock turnover ratio and then find out what are all the impact over the stock turnover ratio in the following cases. First case is sale of goods for 20,000 rupees, cost is for 16,000 rupees. So we are going to sell the goods and when we sell the goods, we have an decrease in your inventory, then closing inventory. So it will have an impact. Increase in the value of closing inventory by 20,000. So when your closing stock also changes, we will have a change in the average stock. Then goods purchased is 40,000 rupees. Already we have a purchase of 1,60,000. When we have an additional purchases of 40,000, the total purchases comes to 2 lakh rupees. Again we have an impact. Then purchases returns is 10,000 rupees. So we have to calculate up net purchases. Net purchases is total purchases minus your returns. Then goods costing rupees 5,000 is withdrawn for personal use. This is your drawings. So the drawings will reduce your purchases. Then goods costing rupees 10,000 distributed as free samples. So this goods which are distributed as free samples will be taken as an advertisement expenditure. Though it is taken as an advertisement expenditure and shown in your trading and profit and loss account, this decreases your purchases, because any sample that is distributed to the consumers will be distributed only at the cost price. So this will have a decrease in your purchases. We shall now see what are all the impact the transactions will have over your stock turnover ratio. So with the given information, first of all we are calculating what is cost of goods sold. Opening stock plus purchases minus your closing stock. Opening stock is given as 20,000 rupees. Purchases is given as 1,60,000 and closing stock is 60,000. So we have a cost of goods sold as 1,20,000 rupees. Average stock is opening stock plus closing stock by 2. So we have opening stock of 20,000. This is 60,000 is your closing stock. We have an average stock of 40,000. So 20 plus 60 will get 80,000 rupees, divided by 2 will get 40,000 rupees. Now the stock turnover ratio, cost of goods sold divided by average inventory. Cost of goods sold we have calculated as 1,20,000 rupees. Average inventory is said to be 40,000 rupees. So we have 3 times as your inventory turnover ratio. If you want to calculate it in terms of period, that is we can have 12 months divided by 3 times will give you 4. So in every 4 months we are going to have the turnover. So for each and every quarter we are going to have one turnover of your stock in your organization. Now we shall see each and every transaction and we can see about the impact over the stock turnover ratio. First is we have sale of goods for rupees 20,000, cost is 16,000 rupees. Now the cost of revenue from operations, that is your sales. Revenue from operations we say that is your sales. Cost of goods sold will increase because decrease in your closing inventory by 16,000 rupees. So cost price is 16,000 rupees. To this extent, closing inventory will get decreased. So already we have a closing stock of 60,000 rupees. Minus this 16,000 will give you this 44. That is 60 minus 16 will give you 44,000. So this is your closing inventory. See to it, we have a 44,000 rupees. Opening stock remaining the same. Now the cost of goods sold is 1,60,000 rupees. Now we have purchases is 1,60,000 rupees. Now the cost of goods sold is 1,36,000 rupees. Average stock, we have opening stock of 20,000 and we have a revalued closing stock, that is 44,000, divided by 2 will get 32,000 rupees. Now it is 1,36,000 divided by 32,000, we will have 4.25 times. Already we have 3 as your closing, stock turnover ratio. Now we have 4.25, so we have an increase over your stock turnover ratio. So with the given information we have calculated as 3, now it is 4.25. So we have an increase in the stock turnover ratio. See to it, when the goods are sold, 16,000 is sold as cost price. Now this will decrease your closing stock. When it decreases your closing stock, we have an impact over the cost of goods sold. When the cost of goods sold is calculated, then we have to calculate average stock. Again closing stock will be getting decreased. So we have 32,000 as average stock. When we have the stock turnover ratio, we have 4.25 times, that is said to be an increase in your ratio. Next transaction is increase in the value of closing inventory by 20,000 rupees. So now the closing inventory gets and increases. Already we have a closing inventory of 60,000 rupees. So 60,000 plus your 20,000 will give you 80,000. this is your closing inventory. See to it, 80,000 is here. Now the opening stock is as usual, purchases is as usual. Now we have an increase in your closing stock. Now our cost of goods sold is 1 lakh rupees. Now what is this cost of goods sold? What is actually sold in an organization? Again, this will have an impact over your average stock. 20 plus 80,000 by 2, we have 50,000 rupees. So 1 lakh divided by 50,000 rupees, we have 2 times. So as we have the stock turnover ratio, previously we had 3, now it is 3, 2. So we have a decrease in your ratio. So we have, whenever we have an increase in the value of closing inventory, that will decrease your cost of goods sold, because closing stock increases means we have not sold it to the public. So this cost of goods sold will decrease. When cost of goods sold decreases, your average stock will increase. That is because your stock in your hand has increased. So the stock turnover ratio gets decreases. Next is goods purchased for 40,000 rupees. Already we have 1,60,000 as goods purchased. Now it is 2 lakh rupees. So 1,60,000 plus your 40. So we have 2 lakh rupees as your purchases. Now opening stock remains constant and your closing stock also increases by 40,000 rupees, because already we had 60 and we have 40,000 as your purchases, additional purchases. So your closing stock will increase by 1 lakh rupees. So your cost of goods sold is 1,20,000 rupees. See to it, cost of revenue from operations, namely the cost of goods sold, will remain unchanged because increase in purchases by 40,000 will have an increase in closing stock by the same amount. See, 1,60,000 plus 2 lakhs is here, again 60 plus 40, 1 lakh is here. So we have an increase in the purchases and your closing stock by the same amount of 40,000 rupees. Now average stock is 20 plus 1 lakh, we have 60,000 rupees. So 1,20,000 is the cost of goods sold, 60,000 is your average stock, we have 2 times. Now we have a decrease in your stock turnover ratio. Previously we had 3, now it is 2. Next transaction is purchases returns. When we have a purchases returns of 10,000, purchases returns woman, we are returning to the supplier. Now what will be the impact in your stock turnover ratio? When we are returning it, already we had 1,60,000 as your purchases. Now we are returning 10,000 rupees to the supplier. So your total purchases is said to be 1,50,000 rupees. See to it, we have 1,50,000 rupees. Now your closing stock is already 60,000. Now we have returned 10,000. So the closing stock decreases by 10,000. That is your 50,000 rupees. So whenever we have a returns of 10,000 rupees, your cost of goods sold remains unchanged, because a decrease in purchases by 10,000 will have a decrease in your closing stock by the same amount. Hence the cost of revenue from operations, that is your cost of goods sold, is again 1,20,000 rupees. Now average stock is 20,000, already we have a opening stock and we have closing stock of decrease by 10,000, that is 50,000 rupees. By 2, we will get 35,000 as your average stock. The stock turnover ratio is 1,20,000 divided by 35,000, we have 3.43 times, so we have an increase. So originally we had 3, now it is 3.43, so we have an increase. So whenever the purchases returns are made, the stock turnover ratio will increase. Next is goods costing rupees 5,000 withdrawn for personal use. When we say personal use, it is at drawings. So when we have a drawings, any amount will be taken by the proprietor for his personal use only at the cost price. So it will have an impact over your stock. Now cost of revenue from operations will remain unchanged, because the purchases will decrease by 5,000 and the closing stock will also decrease by 5,000. Because only from purchases, the proprietor will take the amount to his own personal use or to his home. So this same amount will be get affected in your closing stock also. So already we have 1,60,000 as your purchases, minus your 5,000 will give you 155. That is your purchases amount. See, we have 155. Now closing stock is already we have a 60,000, minus your 5,000 rupees will give you 55,000 rupees. Now we have a decrease in purchases and we also decrease in your closing stock. So we have a cost of goods sold as 1,20,000 rupees. Now average stock is 20,000 as usual, we have a opening stock. Closing stock is 55,000, so we have 35,000 rupees. So we have 20,000 as your cost of goods sold, 35,000 as your average inventory. Now the turnover ratio comes to 3.43. So we have an increase over the old ratio of 3. So when we have a drawings worth rupees 5,000 rupees, it will have an impact over your purchases and also the closing stock. So this will increase your stock turnover ratio. Next transaction is goods costing rupees 10,000 distributed as free samples. Now when the goods is distributed as free samples, again that is made only at cost price. This will have an impact over the purchases and also the closing stock again. So purchases will be decreased by 10,000 and your closing stock will also decrease by 10,000 rupees. So 1,60,000 is your original purchases minus your distribution of goods as free samples 10,000 will get 1,50,000 rupees as your net purchases. Now closing stock we have 60,000 rupees minus your 10,000 will give you again 50,000 rupees. This is your closing stock. Now what is your cost of goods sold? Opening stock remains constant as 20,000 rupees. Purchases is decreased by 10,000. Closing stock is decreased by 10,000. We will have a cost of goods sold as unchanged being 1,20,000 rupees. Again average stock is opening plus closing by 2. 20,000 plus 50,000 by 2 will get 35,000. Again we will get 3.43 times, which is said to be an increase over your old ratio as 3. So this is how the stock turnover ratio is studied. Whenever we have a change in your purchases, we will have a change in the closing stock also. Whenever we have any drawings made by the proprietor, we have an impact over the purchases and closing stock. So whenever we have the changes in the purchases and your closing stock, it will have an impact over the stock turnover ratio. We shall pass on to the problem number 3. The current ratio is 2.1. 2.5 is to 1. State giving reasons which of the following will improve, reduce or no change in the ratio. So current ratio, as you know, it is said to be current assets divided by current liabilities. Current assets being the components as stock, data, bills receivable, we have cash, bank, prepaid expenses, outstanding incomes. Current liabilities were sundry creditors, bills payable, outstanding liabilities, income received in advance, and we have the bank overdraft. So whenever we have a change in the current assets and current liabilities components, we will have a change in the current ratio. Repayment of long-term loans. So this has a two-way effect. One is long-term loans is going to reduce and we have a reduction in your cash. So when we have the change in the current asset, it will have an effect over your current ratio. Goods purchased on credit for 3 months. This current liabilities is going to increase. Purchase of computer for account section on credit allowed by the vendors. It will have an impact over the current liability. Then purchase of building by issuing debentures. So this is a transaction wherein we have the long-term liability and a long-term asset. That is your fixed asset. So we don't have any change in the current asset component or your current liability component. Revenue from operations, that is your sales. 20,000 on credit for 1 month. Cost of goods sold is 15,000 rupees. So we have a revenue, it's a credit liability, transaction. So your debtors is going to increase. Cash collected from debtors. The debtors is going to decrease and your cash is going to increase. Cash paid to creditors. Creditors will decrease and your cash will also decrease. Then we have payment of outstanding liabilities. Outstanding liabilities being a current liability will decrease. Again cash will decrease the current asset component. Then sale of goods for cash and then cash will increase. Issue of shares for cash. Cash will increase and your capital will also increase. Bills receivable drawn on debtors for 2 months. So when we have the bills receivable drawn on your debtors is going to decrease and your bills receivable is going to increase. Bills receivable collected at maturity. Bills receivable is going to decrease and your cash will increase. Now let us see how this affects your current ratio. The first transaction, repayment of long-term loans. It will decrease the total of current assets. Cash being a component of current asset, it will decrease the total of your current assets. The total of current liabilities will remain unchanged because long-term loans will be a component of long-term liability. So the current liability will remain unchanged. What is the ratio now? Current assets divided by current liability. So the numerator gets decreased, the denominator being the same. So we have a decrease in the current ratio. Next transaction is goods purchased on credit for 3 months. So it will increase your current assets because stock will increase and current liability will also increase by the same amount because it is purchased on credit. So when it is purchased on credit, it will have an impact on your sundry creditors and the stock of your organization. So it will increase the liability and also it will increase your current assets. So we have a decrease over your current ratio. Next is purchase of computer for account section on credit allowed by the vendors for 2 months. So we have an increase in your current liabilities as it is purchased on credit and total of your current assets will remain unchanged because any computer purchase for the account section will become part of an asset. So it will not come under current asset. So the ratio will decrease. Next is purchase of building by debentures. This debenture is said to be a long-term loan and building is said to be a fixed asset. So both are not connected with your components of current asset and current liabilities. We don't have any impact on the current assets and current liabilities. So we don't have any effect on the current ratio. Next is a revenue from operations. That is your sale of goods for rupees 20,000 on credit for 1 month. The cost of goods sold is 15,000. This will increase your total of current assets because cash, cost of goods sold is 15,000. It will increase your current assets and your total current liabilities will remain unchanged. So this, when you are going to sell, it will increase the component of your current asset because it is sold on credit balance, the debtors will increase. Debtor is said to be one of the component of your current asset. So it will increase the current asset and it will not increase any liabilities. So the impact will be increase in your current ratio. Next is cash collected from debtors. So when cash is collected from debtors, that sundry debtors account will get reduced and cash account will increase. So this debtors and cash is said to be the components of your current assets. We have the reorganization of your current assets again. We don't have any change in the total of your current assets. It will not change the total of current asset because one current asset is replaced by another. The total of current liabilities will also remain unchanged. So we don't have any impact over the current ratio. Next is cash paid to creditors. When cash is paid to creditors, cash is going to decrease and creditors is also decrease. So we have the impact over the current assets and also the current liabilities by the same amount. So the ratio will increase. The payment of outstanding liabilities. When outstanding liabilities is going to be paid, cash will decrease and outstanding liabilities will decrease. So it will decrease the current assets and the current liabilities by the same amount. So it will increase your ratio. Next transaction is sold goods for cash. So when sale is good made at a loss because cost is 24,000, we are selling it only for 20,000. We have a loss of 4,000. It will decrease the total of current assets. Now current liabilities will remain unchanged because it is sold only for cash. So it will decrease the current ratio. Next is issue of shares for cash. When shares are issued for cash, the cash will get increases. So the total of current assets will increase. However, the total of current liabilities will remain unchanged because issue of shares is said to be one of the component of your capital. So it will not have any impact over the current liabilities. So it will increase your ratio. Next is bills receivable drawn on debtors for 2 months. When bills is receivable on debtors, the debtors will decrease and bills receivable will increase. So it will not change the total of your current asset because the change in one current asset will have the same change in another current asset. So it will not affect the total of the current asset. Again, current liabilities will remain unchanged because the two aspects are within the current assets. It will not have any impact over the current liabilities. So, we do not have any effect in the current ratio. Next is bills receivable collected at maturity. When it is collected, again cash gets increased, bills receivable gets decreased. So, it will not change the total of your current asset because one current asset, namely the debtors will be replaced by the, bills receivable will be replaced by the cash. Now, total of current liabilities will remain unchanged. So, we do not have any impact over the current ratio. This is how the impact of the transactions over the current ratio is studied. Next, we shall pass on to the fourth one. When current ratio is 3:1, state the reasons for the following transactions. Declaration of your final dividend, issue of bonus shares out of profits, bills receivable endorsed in favor of a creditor, endorsed bills discounted, bills receivable dishonored at maturity, bills payable accepted for 3 months, bills payable paid at maturity, redemption of preference shares out of proceeds of your fresh issue of shares, fully convertible debentures converted into equity shares. Now, let us see one by one. First one is declaration of dividend. It will increase your current liabilities. Any dividend declared in your annual general meeting is said to be a current liability. The total of your current assets remains unchanged. So, we have a decrease in your ratio, that is current asset divided by current liabilities. Your numerator remains unchanged and we have a increase in your denominator. So, we have a decrease in your ratio. Next is issue of bonus shares out of profits. When we have a change in your shareholders funds here, so we are going to decrease your reserves and surplus and increase your share capital. No way it is related with current assets or current liabilities. So, we do not have any effect over the current ratio. So, this will come only under the shareholders funds. Bills receivable endorsed in favor of a creditor. Now, when it is endorsed in favor of a creditor means the bills receivable will decrease and the liabilities, current liability, namely the sundry creditors will also decrease. So, the decrease in your current asset, namely the bills receivable, will be offset by the decrease in your sundry creditors. So, we have a increase in your ratio. Next is endorsed bill dishonored. When the endorsed bill is dishonored, it is again taken to the sundry debtors also. So, it will increase your total of your current assets because any endorsed bill, endorsement woman, any bill received from the debtors will be endorsed, it will be passed on to the creditor for the payment of the amount. When the endorsed bill gets dishonored, your creditor will return the bill to you and you have to return the bill to your debtor. So, it will increase your current assets. At the same time, current liabilities will also increase. Your creditors will also increase and your debtors will also increase. So, it will decrease your ratio. Next is bills receivable dishonored at maturity. So, any bills receivable which is not paid, dishonored means it is not honored, which is not paid at the time of your maturity. What will happen to the current ratio? It will not change the total of your current asset because your bills receivable is going to decrease, at the same time your sundry debtors will get increased. So, it will be replaced by another. The decrease in bills receivable will be replaced by the increase in your sundry debtors. So, total of current liabilities will remain unchanged. So, we do not have any effect over the current ratio. Next is bills accepted for 3 months. Bills payable is accepted for 3 months. When bills payable is accepted for 3 months, sundry creditors will decrease and bills payable will increase. So, we have a again change within the current liabilities. So, total of current liabilities will not get changed because one liability will be replaced by another liability. Now, current assets will also remain unchanged. So, we do not have any impact over the current ratio. Bills payable paid at maturity. Bills payable is paid at maturity means bills payable will get decreased, again cash will decrease. So, current assets will decrease and again current liabilities will also decrease by the same amount. So, it will increase your current ratio. So, if both the denominator and your numerator decreases, it will increase your ratio. Redemption of preference shares out of proceeds from the fresh issue of your shares. So redemption means repaying of your preference shares. And this repayment is made out of your fresh issue of equity shares. When fresh equity is issued, you will receive the cash and the cash will be utilized to repay your preference shares. All these items are said to be your preference shares and your equity shares are said to be the shareholders' funds. Now cash is coming in and cash is paid. So we assume that whatever we receive in your fresh issue of equity shares will be paid to the preference shares in full. So the amount that is realized from your fresh issue is totally deployed, which will be fully utilized to pay off your preference shares. So in this case, we don't have any impact over the current assets because whatever cash that is brought in is paid now. So we don't have any impact over the current ratio. Next is fully convertible debentures converted into equity shares. When we have this convertible debentures, it is converted into your equity share capital. The debenture is a long-term borrowing and equity share is said to be a component of your shareholders' funds. So we have a change in the long-term borrowings and a change in your shareholders' funds. Neither the current asset nor the current liability gets affected. So we don't have any impact over the current ratio. So this is how the impact over the current ratio is studied. We shall pass on to the next one, problem number 5. The quick ratio is 1.7:1. Quick ratio woman, quick assets divided by quick liabilities. If quick liabilities are not available, we take into account the current liabilities. Quick assets is the total of current assets minus your stock and prepaid expenses. Quick liabilities is total of current liabilities minus your bank overdraft. So the formula will be either quick assets divided by quick liabilities or your current liabilities. Quick liabilities can be taken if you don't have any bank overdraft. We will take current liability as synonymous one to your quick liabilities. Purchase of inventory for cash. Then cash collected from debtors. Sale of goods costing rupees 10,000 is for 60,000. Sale of office furniture, book value is 10,000, it is sold for 7,500 at a loss of 2,500. We shall see what will be the impact over the ratio, quick ratio. First one is purchase of inventory for cash. When we purchase the inventory for cash, cash will decrease. So the quick assets will decrease and total of your current liabilities will remain unchanged. So we take current liabilities as a denominator now. Now the numerator decreases and your denominator remains unchanged. It will decrease your ratio, quick ratio. Then cash collected from debtors. So this cash collected from debtors will have an impact over the cash and debtors, which is said to be the component of your quick assets. Cash will increase and debtors will decrease by the same amount. So we don't have any impact over the quick ratio. Then sale of goods costing rupees 10,000 is sold for 60,000 rupees. So we have a profit of 50,000 rupees. This will increase your total of your quick assets because the cash will increase and total current liabilities will remain unchanged. So your numerator will increase and your denominator remains unchanged. We have an increase in the quick assets ratio. Then sale of office furniture, the book value is 10,000, it is sold for 7,500 and we have a loss of 2,500. This will increase the total of your quick assets and the total of current liabilities will remain unchanged. As this is said to be a current asset, we have taken office furniture as a current asset. So we have office furniture is said to be a fixed asset. As we are selling it, cash will increase. When cash increases, the total of your quick assets increases and the current liabilities remains unchanged. So being an increase in the denominator and increase in the numerator and the denominator remaining the same, it will increase the quick ratio. So this is how the impact of all these transactions over the quick ratio is studied. Hope you would have understood the current ratio, the quick ratio and the debt equity ratio and how the transactions in the business will have an impact on all these ratios. These impact will be studied by the management to take decisions in the corporations. So this debt equity ratio deals with the long-term solvency, current ratio deals with the short-term solvency and the quick assets will tell about the liquid position of your organization. So the long-term solvency, the short-term solvency and the liquidity of an organization will be the economic barometer to measure your performance of the organization. That is the financial performance of the organization. So whatever the transactions that are being carried out in an organization will have an impact over the debt equity ratio, current ratio and the quick ratio. So far we have seen the different transactions will have an impact over these three ratios. Hope you have understood how the decisions will be taken by the organization based on the changes in the ratios. The management will take into account these increase or decrease or no change in the ratios, and they will take the decisions appropriately. Thank you.